Wall Street's calling it a bull market, but most investors still aren't acting like it. One top analyst says we're just getting started, and that means the biggest upside may be right now. So where's the smart money going? I found 6 strong buy stocks rated by analysts, and one of them just hit 52-week highs after beating earnings. Let's break it down. First up, Energy Transfer LP, ticker ET. This isn't your typical utility play. Energy Transfer is one of the largest pipeline operators in the US, moving natural gas, crude oil, and refined products across a vast network that spans nearly every region of the country. In the first quarter of 2025, the company reported $1.32 billion in net income, up from $1.24 billion a year prior. Adjusted EBITDA rose to $4.1 billion. That signals not just growth, but healthy, consistent profitability. Mizuho analyst Gabriel Marin recently raised his price target to $23, citing steady performance and a positive outlook heading into 2026. What sets ET apart is its scale and its income. The company's high-yield dividends make it especially appealing for income-focused investors. Of course, there are risks. Energy prices can be volatile, and regulatory pressure is always a factor in the pipeline business. Still, with a 26% upside according to analysts, Energy Transfer stands out as a stable, income-generating investment with long-term growth potential. But before we move on, here's a quick thought to spark the comments. If the stock market had a personality right now, would you call it confident, chaotic, or just quietly calculating? Let us know what you think. We're curious where you stand. Next, we've got ConocoPhillips, ticker COP. A global oil and gas powerhouse. This company explores, produces, and markets energy across regions like Alaska, the Lower 48, Canada, Europe, Asia, and the Middle East. In its most recent quarter, ConocoPhillips posted $2.8 billion in profit, or $2.23 per share, up from $2.15 a year ago. Production reached nearly 2.4 million barrels of oil equivalent per day. Wells Fargo raised its price target to $117, pointing to strong operational performance and disciplined cost management. Why are hedge funds, 70 of them to be exact, piling in? It's the consistency. ConocoPhillips has a solid track record of delivering shareholder returns through dividends and share buybacks. But as with any oil stock, its fortunes are tied to commodity prices and global demand. Still, if you believe oil has more room to run, COP might be one of the most resilient long-term options in the sector. Now let's pivot to a less obvious name, CRH plc, ticker CRH. Based in Ireland, CRH is one of the world's largest building material suppliers, serving construction and infrastructure projects across North America and Europe. In the first quarter of 2025, CRH reported $6.8 billion in revenue, up 3% year over year. EBITDA rose 11% to $495 million, and full-year earnings are projected between $7.3 and $7.7 billion, assuming normal seasonal trends. Why does that matter? Because global infrastructure spending is accelerating, and CRH is positioned to benefit directly. With disciplined cost control and diversified operations, the company is well-equipped to handle both growth and economic uncertainty. Despite being under the radar for many U.S. investors, it's earned a 27% upside from analysts and a spot in 91 hedge fund portfolios, a clear signal of confidence from the big players. Could that lack of hype be your hidden edge? Next on the list is Trip.com Group, ticker TCOM. This China-based travel giant owns well-known brands like Trip.com, Ctrip, Qunar, and Skyscanner, making it a one-stop shop for global travel services. In June, Trip.com made headlines after strengthening its stake in MakeMyTrip, staying on as the largest minority shareholder. Analysts see this as a smart strategic play, giving the company more exposure to India's booming travel sector and boosting shareholder returns. Citi recently gave TCOM a 78 price target, noting the company's strong valuation and market resilience. Despite early fears that JD.com might shake up the travel booking space, those concerns haven't materialized. JD's expansion has been slow, and Trip.com is still leading the pack. With nearly 30% upside and 46 hedge funds backing it, Trip.com is riding the rebound in international travel, and its global footprint makes it a strong growth candidate for investors looking beyond U.S. borders. Let's move to something at the cutting edge of healthcare. Argenx SE, ticker ARGX. Argenx is a biotech firm specializing in autoimmune diseases, and its flagship treatment, VYVGART, is already making waves. VYVGART treats conditions like CIDP and GMG, both of which have historically lacked truly effective options. Bank of America has a price target of $804 for Argenx, based on Vyvgart's strong results and growing adoption. The treatment has shown superior safety and efficacy compared to older options like IVIG, especially in patients who didn't respond well to previous therapies. And there's more on the horizon. A pre-filled syringe version of Vyvgart could soon be approved, making it even easier to administer in rural areas and large hospitals. With 54 hedge funds holding positions and a 34% upside, Argenx is emerging as a standout in biotech, though, like all pharmaceutical plays, success depends on clinical trial outcomes and regulatory decisions. Last but not least, AstraZeneca, ticker AZN. While it gained widespread attention during the pandemic, AstraZeneca has quietly continued to build one of the most diverse and innovative pipelines in the pharmaceutical world. Its focus now? AI-driven drug development and expansion in emerging markets. In June, AstraZeneca announced a new partnership with CSPC Pharmaceutical Group to develop novel oral drugs, backed by a $2.5 billion investment in Chinese R&D facilities. The goal is to create next-gen treatments for chronic conditions using AI-powered platforms. This deal strengthens AstraZeneca's position in China, already a critical growth market for healthcare, and reflects the company's commitment to global innovation. With treatments spanning cancer, cardiovascular, and respiratory care, AstraZeneca's portfolio is both deep and broad. Analysts project over 34% upside, and 56 hedge funds are already in. Like any major pharmaceutical stock, there are risks tied to drug development timelines and competition, but AstraZeneca's track record makes it one of the most compelling long-term names in global healthcare. Now, if we take a step back and look at the numbers side by side, the story becomes even more compelling. Energy Transfer may have one of the lower stock prices on this list, sitting at just $17.97, but don't let that fool you. With a massive $83 billion in revenue and a 7.2% dividend yield, it's a powerhouse for income investors. The gross margin is lower at 12.37%, but that's typical for midstream energy companies. The real draw here is consistency and cash flow. ConocoPhillips, priced at $93.88 with a $118 billion market cap, brings stronger margins, nearly 30%, and a healthy 3.3% dividend yield. Combine that with an impressive $7.88 in earnings per share, and you can see why it's one of the more attractive energy plays for total return. Then there's CRH plc, trading at $94.94. While not flashy, its 35.57% gross margin and $4.73 EPS shows strong operational efficiency. It's one of the most overlooked infrastructure stocks in the US, but with nearly $36 billion in revenue and growing exposure to global construction, it may not stay overlooked for long. Trip.com, priced at $58.70, really shines in its margins, over 81%, which is rare in this group. That level of profitability speaks to its dominance in digital travel services. With $7 billion in revenue and a $38 billion market cap, this is a stock that's well-positioned for future travel booms, especially across Asia. Now look at Argenx. At over $543 a share, it might seem steep at first glance, but there's substance behind that price. A gross margin of 89.2% and an EPS of $12.76 signals serious profitability potential. It's not paying a dividend, but that's common in biotech. The real upside here is growth through innovation. And finally, AstraZeneca, priced modestly at $69.45, with a staggering $215 billion market cap. Its 72.58% margin and diversified revenue of $54 billion prove that it's playing the long game. With a 2.2% dividend yield, it's one of the few names here offering both income and innovation. So there you have it, 6 strong buy stocks with real potential spanning energy, infrastructure, biotech, travel, and global pharmaceuticals. Each one has clear upside, analyst conviction, and growing interest from institutional investors. And here are 6 quality stocks under $10 with big upside. Click on this video here